One of the common mistakes investors make is confusing investing principles, which may be timeless, with the need to keep your portfolio strategies timeless. We'll explore more this week. So while our industry on the one hand is excellent at espousing all sorts of cliches, many of which are in fact based on a lot of investing truths, they don't oftentimes pick up on all their hypocrisy. Most notably, things like don't time the markets, and yet then they'll build an entire investment plan on hopefully you retiring at the right time and not having any market volatility right after that, or relying on past performance. And so again, just one of the things we try to do a lot here is keep each other accountable, explore things from different sides. Because of where we sit right now, worst 60-40 performance in decades.
60-40 stock to bonds.
Stock to bond, yes, thank you very much. Great time to revisit. Now, I'm not, nor are you, in the business of doing a whole lot of told you so's, but we take a fair amount of grief when we don't even deserve it. So every now and then we have to say, we reminded you. Now, if you're a client, you've been positioned correctly based off time, risk. We're certainly not trying to hit the panic button there. But when we talked about the industry, and it was August 7th, we talked about investing in a post 60-40 era.
2020.
2020, what did I say?
Just August 7th.
2020. And here we are two years later, got an email actually from First Trust today, going back to August 4th of 2020 and pointing out just how poorly fixed income is done.
Yeah.
You just did today, maybe not the day people are watching this, a talk on alts. One of the things I've talked about, superpowers as a concept, income, time, volatility reduction, being some of the superpowers one can employ to make it through the types of storms we're in right now.
Sure.
Talk a little bit about alts, explain what they are, kind of what you talked about in your presentation today, the important role that they really need to play for people moving forward as they evolve their strategy and not just rely on what's worked in the past.
Sure. So what we're talking about is alternative asset classes. And as I've explained to clients for years now, to me an alt is just anything that isn't just your traditional stock or bond in the portfolio, like you described in the 60-40. So when we look at alts as part of a portfolio, they can take on many forms. Some are more fixed income alternatives, which are meant to buffer volatility, drive that long-term income stream that our clients need, especially if they're in the distribution phase. But you can also have equity alternatives that are meant to diversify the growth pool of the portfolio. And in the presentation that I did today and talking about how we've used them going back to 2012, 2013, is that idea of diversifying risk. And that really is what an alternative asset class is meant to do. Take on less correlation to stocks and bonds, and then look and act differently when we get into these tumultuous market cycles. So today, walking through that with the group that was here was just all about that. When you can diversify the risk in your portfolio, it gives you opportunities in these kind of markets to stay propped up. The less we fall, the less we have to dig out of when things turn back the right way.
Mm-hmm. I think two other important takeaways from just the alternative discussion or even the diversification discussion, because a lot of times it's like, okay, are we even asking the right question? One of the questions I get around diversification is like, well, yeah, but I got 50 stocks in my portfolio. Well, if you have 50 stocks, you have likely diversified away from the risk of owning an Enron with all of your portfolio and getting entirely wiped out. You haven't really addressed diversification in the way that you're talking about, which is buffering overall portfolio volatility. If you have an emergency need, likely having a part of your portfolio that's held up to help you make that need. The other important thing, that I would stress to clients, and is certainly a big part of our income methodology here, is alternative asset strategies. So if you take like a couple of the S&P 500, in essence, strategies we have, but with a call writing overlay or something like that, to again help produce income for you. It's all about ultimately buying time? How do you stay in the game? How do you not have to be a forced liquidator? Any questions that came out of your presentation today that you thought were particularly insightful or that people might be having on the other side of this line?
Yeah, I think people are just really looking at when they, even if someone understands what an alt is, they just want to know what it's meant to do in the portfolio. So that goes back to that idea of correlation. We just want things looking and acting differently in the portfolio. So as you said, whether that's in a time like this, if someone needs some dollars from the portfolio, we're not selling at a loss, or having those areas in the portfolio that are just looking and acting differently. A lot of the questions today were more around, how do I know if I have the right alts in my portfolio? And to be candid, I think this would be a time when you could really tout having an advisor. It would be difficult to go pick alternatives on your own as a retail investor.
Well, and in a lot of cases, a lot of the things we work with, they don't work with retail clients. So they only want to, because they trust the advisor will not be as reactive to markets and give them the time they need, that you literally have to have an advisor to get access to what arguably might be a lot of the alts you want to have.
Absolutely. No, from my perspective, when it comes down to how we're utilizing alts in the portfolio, I think we've done a great job over the years of being forward thinking. You can't time the markets, as we know, but you can start to look at patterns. And it's been very clear over time where alternative asset classes should not only be playing a role over the past 10 years, but I think will become even more important in the coming 10 years, as more than likely we're not going to get some of those, robust equity returns year over year like we just experienced.
I've said this before, kind of anecdotally, but absolutely powerfully, when people are like, well, how do I know if I'm making the right decisions or in the right things? One of the telltale signs is how hard is it for you to have made that decision? I mean, buying tech stocks when they're soaring 25% every year is not a big struggle. The other one, kind of a corollary to that, is the more of your explanation for why you own something that becomes narrative-based as opposed to fact-based, or something around the line of this time it's different, the more you should be worried. The last thing I'll say, somewhat tongue-in-cheek, but very true around diversification and whether you know you're diversified, is I heard the quote, if you're diversified if there's some part of your portfolio you don't like all the time.
Yep.
Because again, the idea is they're not all acting. So yeah, when the stock market's soaring, there's going to be some part that's kind of plodding along, you're not as thrilled with. Conversely, when those equity markets change, those are the parts that are going to buoy up the portfolio that are going to rise to the top of your popularity list. With that, we're here all the time to help you address, do you have the right alts? Do you have the portfolio you need to have? We welcome markets like this because it creates great conversation. We'd love to have one with you.